In this video, we are going to discuss how to choose a company for infinite banking and overfunded whole life policies. What are the new dividend rates for some of these companies? Why we believe one company decided to keep their dividend the same while every other company increased theirs? How the current economy is affecting dividend rates, and what are some of our favorite companies and why? With that being said, please enjoy as my colleague and business partner, founder of Better Wealth, the Better Wealth channel, and the author of The And Asset, Caleb Guilliams, have this discussion. What do you know right now about some of the best insurance IBC companies from what you are aware of and what you've been hearing from other agents that you do masterminds with, and also from internally from the team that we have here?
I remember like early on when I was trying to find like the perfect company, and you'll realize there's no the perfect company, but some of the talking points are they mutual versus not mutual? The ratings of the companies. Do they pay dividends? Dividends are like, obviously higher dividends could be better, but you've also made a video on your channel that doesn't always mean that you're going to have a greater return in the policy because you have a high dividend. And then a big talking point is direct recognition versus non-direct recognition and how loans are taken. And then when we're speaking of loans, there's the different loan rate. And so it could be very overwhelming because it's like, okay, I got mutual, check. But then there's a lot of mutual carriers that do whole life. Can you properly design the policies? How do dividends work? How do loan rates work? Are loan rates direct versus non-direct? And then I wasn't this smart. I didn't know this at the time, but like how people do underwriting. Also, like you could have company A that looks great on paper, but they're really strict with underwriting. You could have company B that could take a certain risk class and potentially give them a better policy because they'll give them a better underwriting status. And so there's a lot that goes into this. And that's why if someone just represents one company, it's tough to say that they're going to be the best across the board, because no one company should be the best across the board because we're dealing with risk.
Caleb, what are some of the key characteristics in regards to the very beginning that you said? You talked about mutual carrier, dividends being important, finance. Like, what are some of those parameters?
I think if we had to simplify, simplify, it would be mutual, company strength. Can you design a policy with high early cash value with flexibility? So the design of the policy is important, and how you use that money. Obviously, the loan rate and the speed and even the infrastructure and how you can take a loan. Those would be about if you have a solid mutual carrier that has good ratings, that you can design a policy super well, and that you can utilize that money efficiently. Those would be like the four things. And you could say number 5 is long-term growth rate, but that's part of the policy design. Obviously, the policy has to be attractive, but though if I had to simplify, those would be the check marks. And you could even say mutual and ratings could go in the same thing. So really, we could talk about company, policy design, use of money. Those would be like the 3 categories I would simplify it to if I had to in a discussion. So our media team, as you're watching this, put this video up for them to go watch, the viewers. Selfish plug in regards to the video that we just recently did. It's called The Best and Worst Life Insurance Companies to Use for Infinite Banking. At the end of it, one of the, really 2 of the companies I talk about is Primerica and WFG. I rated those the lowest of the low relative for the infinite banking concept. We talked about some of the great characteristics within why we would use certain companies, financial, mutual, et cetera. But what are some super key things to like focus on as a consumer shopping around, like what company to use? Like, why should they stay away from certain companies maybe? Yeah, I think that first of all, when you're now dealing with some of the network marketing style companies, you're only as good as the person that's connecting you or helping you. And I have nothing like I love the fact that they're getting people licensed and people's lives are being changed. But the reality is you kind of have the blind leading the blind. And that creates an element. So maybe the 4th thing is like when we're talking about companies, and I'm assuming that you're talking through the lens of us working with us, but you want to make sure that the person, like the agent, the person that's helping you, can navigate these 3 things well. And so the potential issue I have with a lot of these maybe network marketing companies is number 1, the carriers that they're using don't necessarily always check the mutual or great ratings. Usually the ratings are checked, but usually the mutual's not. They're not designing policies, in my opinion, that are a win for their client and flexible. They don't really understand what's going on. They know the talking points and selling points, but they don't really know what's going on. And then utilizing the money throughout your life is not efficient, especially early on. So with all those factors are why I would say, like, I kind of look to that and be like, I would have question marks with that. Now, the positive is they're getting a lot of people insurance, and a lot of people are buying life insurance, and they wouldn't get life insurance if it wasn't for their friends or family getting them in.
Yeah. What I would add to that is, one, I completely agree with everything you said. And two, if a carrier, or maybe an individual, I guess is maybe a better way to say it, is super focused on maybe writing IULs, Index Universal Life. If their goal and intention is infinite banking, maybe it's just like a red flag from that perspective. If you read the book, Become Your Own Banker by the Nelson Nash, he talks about staying away from universal life policies for that concept specifically is a key indicator, is a key thing that we don't want to do. Now, for me, and I think Caleb, you could agree, I'm not demonizing the Index Universal Life. I actually think it has a place in the marketplace. So we don't write Index Universal Life policies. Like our core focus is whole life insurance. That doesn't necessarily mean that I think that Index Universal Life is bad. It's just not something that I would want to personally do as an entrepreneur, someone that wants control of funds to be able to utilize for investment opportunities, so on and so forth. But if somebody, for instance, that is like WFG, they are super focused on IUL, and it's a very complex product. Because it's so complex, it takes managing, reviews, looking at how the market's operating, changing essentially, point to point, like looking at all these small factors that make a big difference in how the policy performs. If somebody has been an agent for 2 months and they're slinging IULs, likely it becomes dangerous for regards to the concept. And I think that's something just to probably avoid and stay away. So definitely look at the person that's selling or having the conversation with you of how long they've been around. Why do they do the product they do? What do they believe in personally? What is the goal? If they're not asking why, or do you want what you want? That's probably a big red flag. And so we're talking about person, but also it relates to the company, because you said it's the kind of the MLM culture where they may not know what they don't know at this point in time, which is perfectly okay. We get tons of agents that come to us all the time and say, hey, I was in WFG. I was in this for, a few months, and I realized it just didn't match my, I don't want to say moral compass, but maybe the culture of the way that I view this world from a paradigm perspective. So that's one thing. And the second thing is, I would say that home and auto companies likely are not the best companies to work with when it comes to this concept as well. I used to actually sell home and auto insurance at PNC. And there was a world where I would look at the balance sheets of some of these companies and see what was going on. And there's like 1 year that State Farm lost like $7 billion just on claims, like due to like hail and things like that. So like they were in a negative surplus, which doesn't add to a very good bottom line from a profitability to helping like the dividend, et cetera, for mutual carriers into these products, right? Obviously what we're using is whole life insurance with a dividend. And the dividend, which we're going to talk about that pretty in depth, is a very powerful component of this concept. And if the dividend is watered down, such as Ohio National at this point in time, they demutualize but still offer a dividend, but it's like super watered down and you really don't have one, the product and the concept becomes null and just isn't very powerful at that point in time. So those are a couple things I'd add, and I completely agree with everything you're saying too. I'm going to list out some of the insurance carriers and their 2023 dividends and their 2024 dividend, and then I'm going to ask you a follow-up question accordingly, and then we'll go from there. So we'll start with Penn Mutual. Their dividend in 2023 was 5.7. Their dividend in 2024, 5.75. Their dividend in 2024 was 5.75. Guardian was 5.75 2023. They're now at 5.9. So they did a 0.15 increase. Mass Mutual went from 6 to 6.1. So they went up 0.1. And then Northwestern Mutual went from 5 to 5.15. So of all the companies that I just shared, they all went up. They increased their dividend, which hasn't happened in a very long time because interest rates were going down. Now that the interest rate environment increased, all of them increased their dividend except for one company. That one company is Penn Mutual. I'm curious from just, it could be a ballpark long shot. You may have no idea. Why in your mind do you feel like that they may have decided to stay constant at 5.75 while every other company decided to increase it?
Historically, Penn Mutual's trounced people when it comes to their internal rate of return. And people would be like, well, Penn Mutual, how can they justify this rate of return? And so potentially they were playing the long game and saying, hey, even we're going to subsidize the dividend. And instead of now, as interest rates go up, them continuing to increase, they're, building back their reserves. I'm saying that from I don't know that to be true, but that would be like my guess, and would love to know your thoughts.
Yeah, I mean, the only way we'd really know, right, is if we went to the president and CEO and said, hey, what is kind of your thoughts and why did you guys decide to stay the same? Which is actually a question that we should ask.
Yeah.
But here's my theory, if I'm just looking at it from the scope. I actually think that Penn Mutual is foresighting into what's coming into the future. So I do believe that people in general, insurance companies and banks, they're very reactive to what's happening in the now. And you'll see, we saw what happened with a lot of the bank failures, right? People did not expect the interest rate environment to skyrocket at the rate that they did. So a lot of these banks lost a ton of money and bank runs happened, the banks went under, so on and so forth. So as interest rate environments happened, I think that the insurance companies just decided to match what essentially their bond portfolios they were getting without maybe thinking about what does 2024, 2025 potentially look like. I actually think that Penn Mutual was the smartest of them all by hedging their bets against what's to come. Because with the statement that I said at the beginning, that the Fed is actually looking to cut rates again, and there's at one point in time in December, there was 7 predicted cut rates to happen in 2024. So if these things are going up and then they're going back down, it essentially, Penn is saying, well, we were profitable, we did well, we're essentially getting these higher returns from our investment portfolio. But if we're going to hedge against the future, what we're going to want to do is try to make sure that we continue to not push out too much, knowing that we don't know what the future is going to look like. Versus on the other side, the other companies were more reactionary, that they said, hey, dividends should be paid out more. We should increase it because current interest rate environment has increased. That's just a theory.
Has Penn Mutual ever dropped their dividend in the last 10 years?
Yeah, every company over the last 10 years has dropped it pretty significantly, just because of the interest rate environment continuing to keep
But
going.
Penn is by far the company that hasn't dropped it as much. If you look back, it'd be good. Maybe on a future episode, we could take a look at that, because I think the other thing is they still, if you do illustrations and you do an apples to apples as good as you can with the apples to apples comparison, they still beat long-term growth rates. And so the other thing would be, some companies are maybe a slightly more reactive. And if interest rates drop, Penn Mutual could potentially just stay the same. People were, believe it or not, saying in the past, was Penn Mutual is being super aggressive. They're not dropping their dividends like other people. And so I think it's cool, the different perspectives and just thinking the long-term game.
Exactly. It's going to be interesting, right? Because if, let's say we go into 2025 and every other company drops their rates again, and then Penn Mutual stays the same again, Penn Mutual will look like the hero, versus in today's world of them staying the same, it doesn't look like a bad thing. It just looks like a neutral thing. And so the other insurance companies oh, this is great, but they're staying neutral. But then if stuff does drop relative, and you and I both know that it's necessarily not the end all be all, depending on what the dividend rate actually is. But if they do stay the same when everybody does decrease, it's just another thing that they can say of we haven't dropped it and so on and so forth many years. But I would say you're correct. From a consistency perspective, over the last 10 years, they have decreased it likely one of the more conservative numbers relative to some of the other companies.
Yeah.
So
one of the things that we'll do our best. This is a promise. So let us know in the comments if you want us to go for this. We'll try to get executives from these companies and ask them hard questions. And we have relationships with some, and some we'll have to maybe call in a favor. But I would love, if you are an executive of a mutual whole life insurance carrier, we want to talk to you. So just that's an invite, and you have a place at the seat at our table, and we would love to ask you hard questions and hear how you got into the space, and then your mindset as you're really in charge of thinking long term for the thousands and hundreds of thousands of people that are insuring their lives and portfolios with you. So that's just an invite, and I look forward to the future conversations we're going to have together, man.
I love that. Why do you think though that the dividend rates don't necessarily matter as much, like relative to when we're looking at a company's performance and like the IRR and those types of things?
Dividends matter a lot if you're with a company and you're comparing year to year. So if you were with Penn or with your Lafayette Life or MassMutual or Guardian, and their dividend is whatever it is and it drops, you can assume that you're going to get a smaller internal rate of return. And if it goes higher, you can assume it's going to be a higher rate of return. The challenge is when you compare company A versus company B, and you say, well, MassMutual has a 6% dividend and Penn Mutual is 5.7. If that's all we cared about, what would the conclusion be? Well, Mass is better than Penn Mutual in this example. Yep. And that's not true at all. It all depends on your scenario. It all depends on the investment return that the companies are getting. It all depends on the type of risk or what they have to pay out from a death benefit or mortality standpoint. Yep. And it also, not everyone gets paid the same. And so certain channels are more expensive to acquire clients. And so at the end of the day, dividends are kind of like a smoke. It's what everyone cares about dividends, but at the end of the day, what is the actual result? And that's where internal rate of return, in my humble opinion, is the best way to compare MassMutual versus Penn Mutual versus Lafayette Life versus Guardian. And in it, you can take the same amount of input and then say, in this policy, this is what I'm actually getting year 5, 10, 15, 20. This is the actual rate of return. And what you might be shocked is it's not always the higher dividend that produces the highest internal rate of return.
Yep. I couldn't agree with you anymore. And if you just think about it logically, if a company's getting a 6% dividend and then another company's getting a 5% dividend, and then we design it for higher cash value with one company and design it for all based with the same company, how in the world can you say that you're going to get the 6% with the same exact policy? And let's say somebody's younger versus older, someone has bad health versus good health, right? You can't across the board say 6% is your growth rate, knowing that there's so many other factors that get put into it. Yeah. So I agree with you that the dividend scale, there's a thing called in-force illustrations. So if you have a policy every year and it's after the first year, you can get what's called an in-force illustration. So like Caleb said, if your dividend increased, let's say you got an illustration year 1, you saw your numbers, and then year 5 was projected to be like $100,000. If your dividend went up, the year 5 projection should now be probably like $102,000 because the dividend increased. The dividend current scale rate is showing in this current moment in time what the future projections will be, which is also why we had this conversation with Bobby Samuelson. Another plug, go to the Better Wealth channel, watch that video if you haven't. I promise you, your life will change if you watch that all the way through. It's over an hour long, but there's so much gold on that video. We essentially talk about that IULs, they have these future projections that become very hard to analyze because these companies are overinflating what their numbers are actually going to project. Bobby was fully transparent and said dividends, on the other hand, do the same exact thing because we have no idea what the future environment is going to be. It just gives us a very good snapshot today on what they could look like. Now we start having to look at the infrastructure on a whole life versus IUL and how they're built and the chastity of like the guarantees versus non-guarantees, which is why we like whole life, right? It's more predictable than it is in an IUL, even if the IUL potentially has maybe a little bit more upside from 1% long-term, right? Yeah. So it's just super fascinating when you start to have the conversation and you start to look at it. These contracts are super complex. And so when you start putting investments and other things into it, it's very interesting.
One thing I just want to plug real quick, I'm going to share a couple things. If you're watching this and getting maybe excited or have questions about your own situation, we want to talk to you, and you can talk to someone on our team that's trained by Dom, by myself, by other really, really smart people like Bobby. And we would love to help you and take a look at what you're currently up to. And so there will be a link down below that says something like Clarity Call. And if you just want to talk to a human about your situation, we would love to give you insight. If you want to learn more about the And Asset, obviously the And Asset channel has amazing videos. The Better Wealth channel has amazing videos, but we have this thing called the And Asset Vault. and you'll get the best, like, here is the and asset content we have written. There's some really exciting things that we're doing. And if you're an advisor or a life insurance agent that's watching this and wanting to learn more, we're doing some really cool things. There'll be some type of call to action. I know we host an annual event for advisors. And if you want to learn more about that, there'll be something down below. But just wanted to give a plug to people that are listening. We definitely want to serve you wherever your journey leads you. And that's one of the reasons why we're doing this show, is to talk about current events and do so in a way where it's relatable.
Love that. Absolutely love that. Let's talk a little bit about the financial strengths and the Comdex scores. How important do you think that the Comdex score with the company is? And maybe explain a little bit on what that is to some degree.
Yeah, so the financial strength of a company, there's different rating agencies, and depending on who you talk to, it's kind of political. It's like, it's sometimes hard to get like the best rating if you there's certain things that people care a lot about. And I think anytime you work with academics, sometimes they major in the minors, but the whole concept is these are independent rating agencies that are saying like, hey, what are your strengths and abilities to pay actual claims? And for instance, if you have like a D- versus an A++, what the rating agencies are saying is, hey, the D- could tell you something on paper, but they're only as good as their promise. They're only as good as their ability to keep that promise. And we're saying that D- is a poor, like, they're not positioned well to do that. And so insurance companies by default are very safe, and they have to keep up with regulations. And so these are like, we're really looking at, like, within the safe companies, what are the ones that are best managing their money to be able to make good on their promises. And so what the Comdex score is it takes multiple of those rating agencies and creates a number. And that number is something that you can use to compare. And so it's good to have. Not what people argue is 100 doesn't necessarily, like a 95 versus 100, we're potentially majoring in the minors. You could be like, why did this company get 5 points more than 95? I think the key thing is, if you're going to a company in the 70s, you may be there might be a bigger difference between a 95 or 100 versus like a 70. And that's where you might want to start asking questions. So I don't know how you would rate my answer on a Comdex score of 100 to 1, but that's how I would talk about the importance of ratings and what they represent.
Yeah, I mean, I would agree with that completely. And if you look at some of the numbers, like Penn Mutual, their Comdex score is 93, Mass Mutual is 98, and New York Life is 100. So if somebody's looking at all of those companies that are 90 and above, it's like, well, how do you choose a company to work with? I think you said it best. It's like you're majoring in the minors with maybe still the financial strengths, because they're all great companies that you can work with. And some of the companies, they just have more money at the end of the day. Some have a gazillion dollars and some have multi-gazillion dollars. Yeah. Obviously, that's in a little exaggeration, but a lot of these companies have more money than countries, which is insane to think about. I mean, even look at Mass Mutual, just like randomly just throwing $100 million at a Bitcoin. Like, it's one of the most risky investments at the time. They're like, hey, we have so much money, let's just throw this random dollars into it, right? And so I couldn't agree with you more. For us, if the company is not 90 or above, we choose to not work with them. And that's just our own personal preference. And so when we talk about the companies we work with, strong financials, A+ ratings, like AM Best is one of the rating companies that are out there. And if you guys are looking for what these companies' ratings are, a little Google search will help. Or if you're talking to an individual that you're potentially wanting to work with, just ask, hey, what is your guys' company's ratings that you work with? What's their Comdex score? Why do you work with them? Like, is it because of their ratings? Is it because they've been around for a long time? Which is another question, is how important is the length of time that you work with a company for? Or not that you work with a company for, but they've been around for.
I would say I wouldn't want to work with a startup, but I don't care if you've been around for 90 years or 120. But I don't want to work with a 9-year-old company. Like, we're talking insurance companies. We're not talking about agencies. Agencies are just people that represent or sell insurance products. You could say we're an agency. We're a middle person between you and actually getting the policy. But the people that are actually manufacturing the policies, I think time frame matters, but it's not like you've been around the longest. That means you're the best.
Yeah. And I think the dividend history is important as well. Yeah. So it's very important that the companies you work with at this point in time have not missed a dividend payment. So if you look at these companies' reports, they share, hey, they've been around for 115, 173 years, 100 and so many years. And they also will say at the end of it, and these usually announcements happen in December or at the beginning of January, say, we have not missed a payment of dividends to our policyholders in the last 175 years, the same amount of time they've been around. It's a super fascinating when you start to look at how have these insurance companies always been profitable through Great Depressions, wars, downturns. Like, I'm just curious why you think or know like why these companies have been so profitable through.
Yeah, it's the same reason why we talked about in the beginning about Penn Mutual. And in reality, all these carriers increase their dividends a little bit. But if you look at the interest rates, I mean, the interest rates went up over 400%. You think about it from like a year. So it's like, why don't these insurance companies pump it up 4x? Well, it's because they're playing a long-term game. And they're dealing with a ton of money, but they're also dealing with a ton of risk, and they're just playing the long-term game there. And so that kind of answers the question of like insurance companies' promises, and the fact that they can even say that they're guarantees. Majority of people can't say that word guarantee, and it's because they're not weathering the storm, but they're also like the same reason why people bad mouth life insurance, because it's not a sexy investment. Well, it's not an investment. And if you follow any of our content, you'll know that we never should sell it like an investment, and that's okay. Like, you should still want it because it's a foundational, safe asset that protects you.
Love it.
But the same like some people want to like soup life insurance up to be a super investment. You got to be careful, because do you want the security and safety and track record of life insurance, or do you want it to just be another investment that could be gone in the future or could underperform?
Facts. Love that. I absolutely love that. Let me ask you a sensitive question, not to you, but in the space of IBC. You mentioned it a little bit in regards to direct versus non-direct at the beginning of the episode. A lot of people in the IBC space live and die by the sword that you should never, ever, right, with a direct recognition company. What is your thoughts around just that statement alone? And maybe what are some myths that people in the space are getting wrong currently?
Yeah, I the Money Guy show, which I did a reaction to because they talked about is IBC a scam, and the way that they said non-direct recognition means you pay the dividend when you don't borrow against, which is correct. Your dividend's the exact same. The direct, when you're direct, that means you don't get paid a dividend if you take a loan. And I'm like, wow, like they took the talking notes off of some TikTok IBCers. And that's just false. Like, it doesn't, a direct means they're directly recognizing that loan and either paying you more or less. And so they're in a case, they're directly recognizing you take that loan. I think when I first started in the space, I sold a lot of Ohio National insurance policies, and they were non-direct. They had a low loan rate. And so for me, like, of course I made a big deal about it, because that's a lot of the people that I was learning said, that's A+. You don't have to that's a risk or unknown that you can wipe off the table. And it sounded good. It was like, hey, your dividend is going to get paid exactly the same whether you borrow against it or not, which is awesome. But then when you're realizing like we're playing a long-term game, and direct recognition companies can be even better, because instead of like affecting the dividend, they could lower your loan rate potentially. And there has been cases where they pay you more because you take a loan, because they're truly trying to, as a mutual company, trying to create fairness. So I think right now I take a step back, and we represent companies that are non-direct recognition and direct. And I think I have a more mature outlook of like, hey, there's not one right or wrong. If you're working with the right company with the right type of policy design, usually it will all kind of work itself out. And if you really want to take early loans, maybe non-direct is the way to go, but not all of our clients are taking crazy loans and doing them frequently. And sometimes a direct recognition company could actually be better. And so I kind of gave a super political generalized answer, but I feel like a lot of people who are passionate about it use it as a sales technique to get you to want to work with them. And I'm empathetic to that because that's kind of how I was trained. And I didn't like milk it, but it was definitely a part of I would definitely mention like, you want to work with a non-direct recognition company. And why did I say that, Dom? Because I was working with a non-direct recognition company and I worked with 2 or 3 carriers and they're all non-direct. So of course I was going to be thing that I was going to say, you know?
Yeah, I love it. And what I will say is we here at Better Wealth, we work with both. We work with direct recognition and we work with non-direct recognition. So essentially what we try to do is if you come to us and say we want one or the other, we'll offer that to you. It really comes down to what you want as a consumer, and being educated on what the difference is, I think is helpful. And to Caleb's point, since the interest rate environment has increased, it's actually super fascinating because you start to look at a company like, let's just say Guardian or Penn Mutual. Guardian is direct and non-direct. Penn Mutual is direct, and even Mass Mutual is direct and non-direct. But if we were to write a contract with the way that we design them, we would work with the non-direct side of Mass Mutual. But back a couple of years ago, the Guardian, they had a fixed loan rate at like 8%, but their dividend was in the 5s at the point in time. And when they borrowed, their dividend went from 5-ish% all the way up to like almost 8%. So by taking a loan against their policy, their dividend actually increased. With that being the case, you said if you have a direct recognition carrier, it may not be good to take a policy loan right away. It may be better to work with a non-direct carrier. I actually think in today's environment, it's actually more advantageous to work with a direct recognition carrier if you're wanting to take a policy loan early in this one moment, in this state of the economy. That's why it's fascinating, because the economy is going to change. It's going to go up. It's going to go down. It's going to go up, and it's going to go down. And we can't necessarily predict it. All we have is today's data. And there are studies that show in higher interest rate environments, direct recognitions will actually perform better, and in lower ones, non-direct recognition will.
What's the loan rate of like a Lafayette Life? Like, what's the lowest loan rate right now with the companies that we work with?
Yeah, so it's a great question. So as Caleb was saying, that the dividend rates, as they increase, right, loan rates will also increase. They go together. Loan rates are more reactive, so they happen a lot quicker. So loan rates will shoot up quicker, either per quarter, anniversary, year to year. And dividends, they can lag and can be year, 2 year, 3 years at a time, where it's like they catch up to whatever the environment is. And so currently, companies like Lafayette Life, like last year, for instance, their loan rate was 5.75%, but their dividend was 5.2%. So their dividend was less than their loan rate. And so as these dividends continue to increase, it's important to check what is the loan rates happening, because they're all going up simultaneously. So it's a good thing for the policy from the dividend perspective, because your cash value should go up, but you also do have a little bit more drag on the other side.
Is their current loan rate lower than Penn's right now?
I would need to check what Lafayette's current loan rate is. I think it's close to like 6% as well. Don't quote me on that, but I would need to check on Lafayette's current.
Well, and here's the moral of the story is the time that you watching this, you could be watching this 6 months from now and things may change. One of the things I just want to mention is like someone might say like, oh, why would they change the loan rate faster than they change dividend rates? And if you think about it, when they give a loan to us, we're an investment on their balance sheet. So they would be cheating everybody if they gave 2% loans. That might be good for the person taking the loan. Amazing. But the opportunity cost, if they can make money in treasuries or safe bonds over here, and now you're taking it, like you're actually stealing from that company. And so the insurance companies, again, you ask the question, why do they last through the Great Depressions, all that? Because they're thinking long term. And when you're a mutual carrier, you want them to make the best decision for the long-term nature of the company, because you are a part owner of this company, and your future legacy payment is predicated on their ability to pay and be good for their payments. So that for me, like some people get triggered, like especially people that are like very like they want to arbitrage their money, they get very analytical, and I'm all about being analytical, but we have to understand like you're building a foundation, and just like when you're building a house, you're not going to the very penny of like, what's the cost going to be to build the foundation. You're usually looking at like what the cost is going to build the house. And in your personal financial life, it's like you're building the foundation, but you can only build as big of a house as what the foundation's going to be. And, part of this is character. Like this, I'm not just saying it's all life insurance, but I'm saying from a financial standpoint, I can't think of a better financial foundation to build your wealth on than life insurance, but it definitely is not the only component. And so it's just, what I'm trying to say is don't be crazy analytical about every little penny and don't try to arbitrage every single dollar, because what you'll find is it's not as sexy as you think, and that's okay.
So, with that being said, one of the questions, and Caleb, this is where your beautiful politicalness will come into play. You could either say yes or no. I'll be more than happy to maybe jump in a little bit. If you maybe just don't even know, or if you're like, I'll defer to you to answer the question. But our media team, they were very specific and said, hey, it would be awesome if you guys shared some of your favorite insurance companies and maybe your top one or two, and like why you choose to maybe work with them or why you like them in general. I'd be open to hear your honest thoughts on, some of your favorite carriers currently, maybe why, and who's in that camp.
I think any company that we're currently contracted with, I just want to acknowledge that that out of the hundreds and hundreds of insurance companies that we could represent, choosing the 5 to 8, like we don't take that lightly.
Yep.
And we're always internal, hard on ourselves and saying like, what can we do better? Because we want the very best companies to work with. And so anyone that we are working with, I feel very strongly about. The companies that we currently really, really like from a leadership standpoint, Penn Mutual has been amazing. Like I actually think we could get the president of Penn on our show, and the leadership team has been really innovative. We talked a lot about them. We've just been really impressed, and we were a little bit skeptical early on, and they've just kind of blown us away. And that Lafayette Life Insurance Carrier has been really good when it comes to like people's ability to front load policies, and their leadership team's wonderful. We also know the president of Lafayette Life Insurance Carrier, and just love their outlook. And so those are two that come to mind. Guardian and Mass, when you want to talk about like a solid, if you want to ever play like the big company card, and they both have solid products. I would say the downside to those companies is we're not going to get a phone call and get executive on. But maybe that's a positive. Like we don't have as good of a relationship with the exec team, but the pond it's like Lake Michigan. So they're not watching our content. I can assure you that. And so, but there's pros to that because they have a lot of money. The con is they have a lot of money. They're big. Mm-hmm. And so are you a number? They maybe could care a little bit less about individual agents or agencies or people. And then One America is one of those carriers that's kind of like in the middle for me. I love their leadership team so much. I love their culture. I don't know if you've ever visited their headquarters. I think you have.
Yep.
Have you?
Yep.
Yeah.
Last year.
Amazing. Like openness. If I had to work for any insurance carrier, it would be them. Just from how they're set up, their culture. Love their commitment to a lot of our friends work a lot closely with them, and they just have some of the best humans. Their underwriting and their policy performance has just not been to the place where we can justify like making them like, hey, like they can be our go-to carrier. I'm hoping, and we're looking every single year, because if you have a policy with One America, you're in great hands. Like from a financial standpoint, amazing. From a front load standpoint, incredible. But when we really get crazy analytical, it's hard to point to where we should use them over maybe some of the other carriers. So but I mean, any of the carriers that we represent are head and shoulders, I would say, above what you could get. And there's hundreds of millions of dollars going to those policies. And the last thing I'll say is I would take a One America policy properly designed over 99% of what other people are selling in any other company that we mentioned. So I think it's so difficult because you're asking a question and we're like the 0.1%. And I don't say that to be arrogant. I'm just saying when you actually look at all the people out there that are licensed, that are selling, very few people are having conversations. Very few people are having conversations about how we can get paid less to do the right thing. And that's where it gets tough. But we would be lying if we said everything is equal, because clearly, if you look at our production, we're choosing to do more business with certain carriers versus others, and you have to justify why. But that's kind of my. Did I share more than you thought I was going to share?
I did. I'm not going to lie. You shared a lot more than I expected, and I loved the answer. And so we've run thousands of illustrations, and if you combine the entire team, multiples of thousands. And we've seen thousands and thousands and thousands of illustrations from other companies as well. So we've seen across the board where each company is essentially aligned with. Now it's hard to keep up with all of them across the board of like all specific IBC companies. But we've looked at the data across the board and we look at it every single year and we say, hey, let's compare. Why is this company good? Why are they not? When would we use them? When would we not? We have to look at it from the underwriting perspective, transparency. We look at it from a commission perspective. We look at it, the ease of use, the ability to take policy loans. It sounds like you wanted to say something. Go ahead and say something if you want. Feel free.
Finish your thoughts.
I'm gonna go on a little rant, so feel free to jump in first.
I think what would be really good is, because I know we have clients, we have people that love One America. We have lots of good people that are with One America. I think it would be really good to get Clay Summers on the podcast, and we should jam about it, because a couple of years ago they changed their premium load.
Yep.
PUA load.
Like,
so before,
it was like high, and now it's like only 6%. Like it's super low now. It's like
before they were like leading. They were like the go-to carrier, and then they increased that. It would be interesting to get their perspective, because what they would say, just like we made the argument for Penn Mutual not raising their deal, is they would say, yes, our illustrations may look less favorable today, but our ability to insert 30 years from now is far better. And so that's where it was like, because they were our number one carrier in the past, and it wasn't because it wasn't because we changed, it was because they made changes, and it was a choice we made. But it would be interesting to get their perspective and see if they would be open to talk about it on our show.
Yeah. And to Caleb's point, it's essentially whenever you sign the dotted line, what is your contract showing you today for like load charges, et cetera, those types of things, how it was designed. That could be different 2-3 years ago than it is today. So the policy will drastically change and be drastically different depending on when you sign the contract. And so that's why for us, it's important that we constantly keep looking at these and update it. Penn Mutual increased their premium load a little bit from last year to this year. It was really at the end of the year. And we said, hey, team, let's look at this. Like, does it affect it enough to where we no longer want to work with them? And we made the decision after looking and comparing to all other companies that they still were a viable option to work with, even though that they increased their premium load charge. And all of the clients that we wrote before that increase, they got the earlier premium load charge that was cheaper. So it's just when are you getting your policy and with what company and what's kind of currently going on with it. And to the point of we write with multiples, it really comes down to what it is you're trying to accomplish. Like, we don't just write with one carrier and like we're not captive, we're not career, because we believe that not one size fits all for everybody. And so we will go to the table and say, okay, Mr. or Mrs. Smith, what is it that you're trying to accomplish? Oh, you're trying to accomplish X. Okay, let's use this carrier because this is what you're trying to accomplish. And to your point, you mentioned the front load strategy. Like, we have lots of videos on the Better Wealth channel and the End Asset channel that talk about the front load strategy that we essentially created. And we talk about the powerfulness that Lafayette Life Insurance Company has based off of like the base to PA ratios and how much liquidity you can get early on. Right? But then if you start removing that, they may not be as favorable. And some of the underwriting is definitely not as favorable with getting approved, how long it takes. And then you start to look at loan rates, direct versus non-direct. Like, there's a lot of pieces that come into the puzzle. And so that's why I did that video, the best and worst life insurance companies. And I explained in each one, I did 10 of them and why I thought that they were good and why they maybe not. And so if you want to recap on that, like obviously go watch that. I'm more than happy to share some more in-depth perspective. One company we really haven't touched base or talked about at all is Mass Mutual. I'm kind of curious your thoughts just around Mass Mutual in general, and your belief in them or non-belief in them, and for what purpose, etc.
Yeah, at Mass Mutual, my thoughts are they're a super solid financial company. You can optimize policies well with them. They'll be super competitive when you're utilizing the policy, so that they check the 3 boxes. And my big deal is like the past has just shared with, like, they're not super excited about max funded, overfunded life insurance policies. They hate the word infinite banking. They've threatened to, can certain advisors and agencies if they use certain language. And so, and we've also had in the past where clients have been questioned about why they're using, there's never been a time where they've not given a loan, but in most cases, insurance companies, in my humble opinion, shouldn't ask, period. And there's been Mass Mutual in the past has sometimes asked, why are things have triggered? And I think they're just a big company. And what I found is we have great relationships we have some great relationships with Mass, but at the big picture, Mass could care less about us or our clients. And I say that really well. I say that's my opinion. Mass's attorneys are like, that's slander. They're just big, and so they don't get emotional about one agent or our clients. Of course, they're mutual, so they care. But I haven't always felt like that they've been like crazy helpful. With all that said, we write consistent business with them, and we're going to continue to write business with them because they help us create a diversified approach. And you'll never lose a case if someone just like if all someone cares about is ratings, and stuff. Like Mass Mutual's always at the table as a scenario to look at.
Yeah, I couldn't agree more. They have a very good big business practice for policies, premium financing, other advanced strategies. They're just not necessarily advertising saying like they want the infinite banking concept policies, versus carriers like One America and Lafayette Life. They really do promote that.
Yeah.
And they are proud of that. And that's awesome. They even do like symposiums and talk about it.
And there's certain companies like Lafayette, One America, even you could put Emeritus maybe in this bucket, where they'll like make exceptions and they'll really listen to someone's situation. If someone's like, hey, I want to put extra money in, here's why. Okay, we'll listen, we'll hear you out. This is why. Usually the bigger the carrier, sometimes the less exceptions will be made. It'll be like, hey, like this so-and-so, like this is why they want to do this. Well, it's like, well, these don't meet the guidelines. Like, okay. Yeah. Like that's my, and it's not across the board, but what I found is when we have a better relationship with an insurance carrier, sometimes they'll listen to what we have to say, and that alone, our clients will get a better policy or better result because the insurance carrier actually took time to listen.
Yeah. Mass Mutual has paid out the second most dividends, so like actual dollars, to their policyholders out of any of the carriers that were essentially in the mutual carrier bucket. The number one carrier is Northwestern Mutual. And so when you start to look at that, it's such a massive scale. So you're just such a little blimp in regards to like us as Better Wealth. Even with the production we do, it's just like a little tiny blimp on their radar of how much business is actually written. And then you start to compare it. So like, for instance, Lafayette Life Insurance, they paid out $103 million of dividend to their policyholders this year. It's a record year for them, but it's awesome. Good for them. They said, hey, this is a record year. We had a fantastic year, as most carriers did. $103 million. Guardian, they're like 5th on the list for like the amount of dividend that's been paid out. I think they may actually be 4th. It's like Northwestern, Mass Mutual, New York Life, and then Guardian. Guardian being 4th, they end up paying like, I think $3 to $5 billion. I'm not exactly remember 3 or 5, which one sticks in my head more, but $3 to $5 billion with a B they have paid out in dividends relative to Lafayette Life, which they paid $103 million. So it just shows the scope and the size of it. But then you look at like Lafayette, and they fit all the other buckets that we're talking about, including still size. Like they have a 96 Comdex score, strong financials, great company, great leadership team. So that doesn't necessarily always matter. Like for us, we don't necessarily jive as well in our business practice with writing Northwestern Mutual, but they pay out the most dividend and they're the largest company. And we have our reasons why that is the case. So it's just across the board. There's so many factors that go into it. And I think what Caleb said at the end of the day is don't look at such the small minutiae detail when you're comparing companies. Is it with a good carrier? Is it designed right? Do you trust the people you're working with? Is it a mutual carrier? Have they paid a dividend for the last 100+ years? And are you using this concept for something that you understand and believe in? And can somebody kind of coach and walk you through kind of how this concept works? And they're being fully transparent on how it actually works. They're not lying or using crazy marketing schemes that this is this way when it actually works a different way. And that's really the important part. And that's why I think we take a lot of pride in is we want to be as transparent as possible. You ask any question, we'll tell you the truth. We'll tell you exactly how it is, even if it's essentially putting maybe a company we use below another company that we don't work with, because all we care about is that you're being served well, that you're living an intentional life, and that we're helping you to live the life that you desire. So.
I love it, man. And I just want to remind you, if you love what we're talking about, it would mean the world if you could take time to subscribe. Share us your biggest insight or question or something that you want Dom and I to speak more on. We'd love to hear from you. And then sharing the content is just one of the best ways to get this out, and it would mean the most to us. And it's really cool when you look at our statistics, we get more shares than we do likes, which boggles my mind. Like we get more shares than we do comments and likes, I think combined on this channel. And that just tells you that people find a ton of value in this and they're sharing it with other people, which is amazing. And so thank you for that. And then also, if you want to talk to someone on our team, we have a link down below. If you want to learn more, we have a link down below. And if you're an advisor that wants to get plugged in, we have a link down below for you. So make sure to check that out. And man, I'm excited for more content and just talking real and reacting to content, answering people's questions, interviewing. It's going to be a blast, man.
Absolutely love that. With that being said, we'll go ahead and wrap this up. And you will see more of Caleb, more of myself talking in this format. We'll bring other people on the team as well to have really in-depth conversations. And like Caleb said, the goal is to get really high-level people in other companies, executive, et cetera, just to hash it out and have fun and talking about life insurance. The goal is to make life insurance sexy again. With that being said, we'll talk to you soon.